Move on to the differences, specifically comparing the differences between merchandiser statements and the statements that we have seen in the first 4 chapters. The red highlighted accounts here are the new accounts. Okay, we have inventory that you will see under balance sheet. Again, this is the asset account. So just like other asset account, the normal balance falls on the debit side. Okay, so meaning whenever we purchase inventory, then amount times the cost that for each and every product altogether, purchases cost falls under the debit side. We increase inventory by debiting inventory account, just like a regular asset account. Okay, once again, inventory represents finished goods. Okay, not the material, not bits and pieces of a product, but it's actually a finished product here. So some of the companies may call it merchandise inventory, some companies may just call it inventory. So these 2 terms you will see in practice, both of them are used. For more popularly, usually inventory is a term used for most cases. Income statement, matching up with the inventory that we purchased. Later on, of course, we want to use this to generate profit, generate revenue. And this type of revenue is called sales revenue. Some companies call it directly just sales. Sales equals sales revenue. Okay, so this is a revenue account. Again, just like other revenue accounts, just like service revenue, interest revenue, any type of revenue account, the balance is on the credit side, normal balance. So when we sell the inventory based on a new market price, the retail price that we set, the inventory amount, the revenue amount will fall under the credit side. Okay, now by generating revenue, we're actually giving away the inventory that we purchased earlier. So we have an account here that matches with the inventory that we purchased earlier, but the account represents the effects of the inventory that has been sold to customer. This is what we call cost of goods sold. Okay, so cost of goods sold doesn't have an expense term in it, but really it is an expense account. So it follows the regular expense rule, debit increase. Okay, this term may be confusing a little bit since it doesn't have the expense term. Just remember that it's similar to the idea of having, earlier we mentioned supplies purchased earlier as an asset, and then when we use up, we call it supplies expense. Or in the chapter 3, we also mentioned prepaid insurance asset account or prepaid rent account. Then when we use up, it's called rent expense or insurance expense. Here for a merchandiser's company, inventory is an asset account that we purchased earlier, the goods, the cost of the goods that we purchased from wholesaler, from supplier. When we resell it to our target customer, it turns into cost of goods sold. Okay, so whatever amount that earlier was captured here, once we sell it to customer, it turns into cost of goods sold. This is an expense account when we sell it. Right, so there's 3 new accounts here on the purchase side of the entry. So on Wednesday, we'll be covering additional accounts for sales side. For purchasing side, we will be increasing inventory. And then when we sell it, of course, it increases sales revenue. Also affects cost of goods sold. Again, this is an expense account specifically just referring to inventory expense. Okay, we don't call it inventory expense, but we call it cost of goods sold. This only represents the used up inventory that we sell to customer. Okay, it doesn't represent any other type of asset. It only represents used up inventory that we sold out to customer.